Hello there. Welcome to Personal Finance 101 channel. We will upload personal finance tips regarding how to save, how to improve credit score, how to overcome debts and a lot more. And if you are new here, kindly click the subscribe button and hit the bell icon to get notified every time we upload new personal finance tips. Let's get started. Here are 5 tips to improve your personal finance. Tip number 1: How to build your credit when just starting out. There is a big misconception among many young people, especially those coming out of college. That is the belief that the only thing that matters is what you do after you get your credit card, not before. That is a terrible misconception that even prevents some from getting a line of credit. Building credit is the act of managing your finances correctly, even if you don't have a credit card. This includes paying your bills on time, your loans, purchases you've made, etc. Let's discuss first the implications of paying bills on time. Even before you apply for a line of credit, ensure that you pay all your bills on time. Took out a student loan? Try to make consistent payments. Student loans are tricky, as a lot of people struggle with them, but it is still important that you pay your dues to Sallie Mae on time. There is also the matter of utility bills that a lot of younger people like to leave for last when revenue comes in. Ensure that when money comes in, bills are the first thing taken care of. Late payments and disconnections will be taken into your account. In the process of building your credit, ensure that you keep your credit card debt low. The recommended ratio of debt balance to credit limit should not exceed 30%, so ensure that you limit your spending to only what is needed, and make frequent and consistent payments. However, do not take this as to say that you will stop using your credit card altogether. If your card is unused over a period of time, then your bank may close that account, which raises your credit utilization. Also, try to stick to only one credit card when you are just starting to build your credit score, as opening too many accounts at once will lower it. Next up is to educate yourself on how credit scores are calculated and reported. Once you know this, you will be making much wiser decisions with your credit card. Once a year, you can pull your credit reports for free from sites like annualcreditreport.com. Sites like this pull reports from the 3 credit bureaus, Equifax, Experian, and TransUnion. Ensure that your credit reports do not contain any errors, and if you spot any, contact your issuer and the relevant agencies immediately. Ensure that you can back up your claims of any errors, so ensure that you have a good history of paid bills and receipts stashed away somewhere. The credit reports that you pull may not contain your score, but you may be able to get it from your issuers, or even places you got your loans, such as Sallie Mae. Finally, when getting a credit card for the first time, look to see if you can get a secured credit card. Even though this option is not for everyone, this will ensure that you consistently have a high score. Secured credit cards are issued with a cash deposit that is equal to your credit limit. This might look like a silly option at first glance, but note that the deposit only acts as collateral, so it is not a prepaid debit card. Once you've built a nice credit score with this, then you can move on to unsecured cards. Tip number 2: How to raise your credit score. There is nothing in the United States that could financially destroy you or set you up for life than your credit score. There is almost nothing you can do without a credit score. Buy a car? Buy a house? Open a bank account? These things and more will require you to divulge your credit score. Of course, we don't all have perfect credit scores, and some of us have somewhat embarrassing ones. You might not have the best credit score in the world, so we will show you how to raise it in the quickest way possible. Do not expect this to be a tutorial about how to raise your credit score by significant digits overnight, as that is virtually impossible. A credit score takes into account how you handled your finances over a number of years. So what we tell you is not just one thing that you can do, you must be consistent in order for your credit score to be raised. The first thing to start doing is pay off your credit card balances. Depending on how you've been handling your cards, this may be a difficult task. However, consistent payments to keep your balance low, even if you are not paying it off, will help raise your credit score. So start paying down your balances every month at the very least. A more frequent payment, such as every fortnight, is even better. Also, watch how you spend from your credit cards, especially if you have multiple cards. It is better to pay a higher amount from one card than splitting the bill among more than one card. Multiple balances equal a lower credit score. So you may have to consider getting rid of credit cards that you likely won't need. The second thing to keep in mind is that you should not be ashamed of your old debt, especially the ones you have paid off. You may find your old debt embarrassing, but they could help your case to raise your score. Don't try to get your old debt off your report as many try to do, or close down accounts, especially those where you've had an excellent repayment record. This point is probably the most important of them all. Do not procrastinate on your bills. Whether it be utilities, car payments or mortgage, paying bills late and doing so consistently will lower your credit score. Even if you want to make a big payment or take your family on a vacation, do not put your bills on the back burner to do any of those things. Consistently pay your bills on time. There are other riskier options that you could take, such as hiring credit repair agents. However, they don't all work out as advertised and a lot of them are scams, so you will have to do your research before going down that route. Be focused on following these steps, and you're on your way to raising your credit score, so you can get that house or that car you've been wanting. Tip number 3. If you get married, are you responsible for mate's previous debts? Marriage is the act of sharing everything about you with your spouse, including your body, emotions, time, possessions, and even your name. So if a married couple has to share the good that each party brings to the table, then wouldn't they have to share the bad as well? Wouldn't each spouse have to take on each other's bad credit? The answer to that is not as straightforward as one might hope or believe. The number one factor that determines if you can be held responsible for your mate's previous debts is the state that you live in. Each state is grouped into two types when dealing with how marriages should be handled: common law states and community property states. Other factors that determine your liability to a spouse's debt are the type of debt that was issued, who the debt was issued to, who the cosigner on that debt is, and how long before, during and/or after the marriage the debt was issued. In common law states, the debt incurred by one party in a marriage is not shared by the spouse. In community property states, however, a spouse will be held liable for a debt incurred during the marriage by any party. These types of states are in the minority, as community property law is practiced only in AS, CA, LA, NV, NM, TX, WA and Y. It is termed community property, because all assets and debts gained during the marriage are owned by the community, which describes the spouses in the marriage. Common law states may seem perfect for those who wouldn't want to share debt, but credit card companies can still come after you in common law states if your card is jointly owned. If you were a cosigner for your spouse's credit card, then they can still come after you. If you and your spouse possess jointly owned assets, then the credit card company can still come after you. In these states, however, what one spouse earns as income belongs to that spouse alone. Any gifts or inheritance received by one spouse belongs to that one alone. If you live in a community property state, then it is basically all the above. If you co-signed on a line of credit or loan, you are responsible for the debts incurred by your spouse. Any debt incurred by you or your spouse during the marriage makes you both liable, even if you didn't co-sign on it. You could still be liable even if the account was opened without your knowledge. There is a small loophole though. Any asset gained as a result of your debt must benefit the community, so if the debt only benefited one person, then it may not be considered a community debt. In these states, all income brought in by either spouse during a marriage is termed community property. However, if either spouse receives a gift only for that person, then that property is deemed separate. If you want out of a community property type of marriage without moving to another state, then you can sign a pre-nuptial agreement, even though there are certain conditions. Tip number 4. Why you should always pay your bills on time. Just imagine a scenario where on a Friday night you invite your friends over for a bi-weekly LAN party. Everyone has their laptops and video game consoles plugged in, and your sound system is playing the latest pop tunes in the background. Everyone's having a blast, then the electricity goes. You look outside the window, and sure enough, the neighbor's lights are on. Try as you may to reset the breaker, your lights stay off and it becomes apparent: the electric company disconnected your power. Not only are you embarrassed, but you are broke as well, as you will have to pay the bills you owe plus the reconnection fee. Apart from that embarrassing scenario, procrastinating on your bill payments can have disastrous repercussions down the line, including reduced credit scores. When you do not pay your bills on time, you will have to pay a late fee, which is even more money than you would have had to pay if you paid on time. Do not look on your late fee as just a small penalty, because that small penalty adds up, and it goes on your record in determining your credit score. Don't feel too bad. Most of us have procrastinated with our bill payments at least once. However, you should always be cautious in the payment of your bills. If you are late, your account is then turned over to collections. They may charge an even greater fee and add on interest as well for the amount of time that has gone by without you having paid your bill. And if it is still not paid by a grace period, your account is disconnected. This information is given to creditor agencies, and your credit rating and score will drop. However, bill collection agencies are not inherently evil, as they will report on time payments as well. If you are a chronic bill payment procrastinator, there are ways to pay your bills on time and save the energy and the boredom that comes with it. First of all, look at all your recurring bills, such as your mortgage, car loan, and utility bills. Most of the companies that provide these services also allow you to set up a recurring payment system. If you want one, just ask the next time you get on the phone with a customer service rep or in the bill payment line. Use calendars, especially online ones like Google Calendar and Outlook, to remind you when you should pay your bills. Speaking of online, if your service provider has online bill payment options, use them. You will need a credit or debit card for that option, but this way you won't have to lift a foot to go to a depressing place. You could also pay by phone, even though it is somewhat less safe than the online version. Another thing you could do is receive bills by email, and this way you could use software to easily get the due date into your calendar. Ensure that you memorize your bill cycle as well. Bills are always due by a certain date of the month, so ensure that you pay it by then. Your credit score is happy when the relationship between you and your bill collectors is a happy one. Tip number 5. Why you should have a personal budget and stick to it. Most of us have been here at least once time in our lives. Every month, a few days away from payday, you go into the kitchen, and see just one packet of ramen noodles left. You then sit down and start to do some intro and retrospection, asking yourself why the heck did you spend all your money on pizza and video games? You borrow a little money from your friends or beg some from your parents, buy some groceries, and you live like a pauper until payday comes around. You promised yourself that this time you will spend your money wisely, but you repeat the process all over again. If you're one of these people, it's time to break out of the cycle. To budget is to plan how you will be spending your money for a period of time. It is best if your budget reflects the time's revenue comes in, whether it is weekly, fortnightly or monthly. Budgeting will ensure that you don't spend more money than you need to, and that you have enough money to spend on leisurely activities and save. Many believe that budgeting is an activity for the poor, but believe it or not, even the rich have to budget as well. The way that most of them got rich in the first place was by being smart with their money, making budgets that reflect the amount of money they bring in, and seeing how much they can invest and save. Many say that budgeting governs the amount of money you can spend, but that may be the wrong way of looking at things. You should look at budgeting as the way to govern how much you can save and invest. Budgeting should not be used as a short-term solution, but it should contribute to a long-term solution as well. Hence, when making a budget, the first thing that you should do is have a reasonable sum of money as your savings, then the rest of the money should be budgeted for food, clothes, bills, etc. Only when needed should money be deducted from the figure set aside for savings. Your budget should have a set structure, a list most likely, and your points should be arranged by priority from top to bottom. At the very top, below savings of course, should be your rent or mortgage payments, along with utilities. After that, have your other monthly payments such as credit card, insurance, and student loans. After that are your other necessities and luxuries, including food, gas, travel, clothing and leisure. Hopefully when you have made all payments, there is sufficient funds left for a significant investment or savings. Do not write your budget the old way. When we make a mental budget, we usually have one flat number for something like food for instance. Look into how much you spend on a weekly or monthly basis and ask yourself if you really need that much. If you spend $200 per fortnight on food alone, you might need to ask yourself how you could cut that by a significant amount. Do you really need to go to Chipotle for lunch every day? Do you really need that Frappuccino from Starbucks every morning? You will find that you will be cutting out bad habits, and you could also be improving your health this way as well. I hope you found this video useful. Please give it a like and subscribe to this channel for a lot more personal finance tips. And I hope to see you on the next video. Thank you so much for watching. See you on the next video.